May price index staying in low positive growth territory and has in recent months shown, very slight acceleration on a year-on-year growth basis. What do we read into this? Because in real terms, we're still looking at negative performance here.
Yes, if you look at CPI, 4.4%, and you compare that to house price inflation or house price growth, year-on-year 2.1% according to our index, it's still negative in real terms or declining in real terms. But in nominal terms, there has been a very, very slight uptick. From a few months ago, it was down nearer to 1%, up to 2.1%. I call it the QE2 bump. I don't read too much into it. I don't think it's the start of any sustainable upward trend just yet, but I think it's a reflection of those two interest rate cuts late last year, which just stimulated a little bit of demand during the summer months. And what we also saw in the summer months was a slightly better GDP growth rate. A lot of that coming from overseas stimuli, most notably QE2 in the United States. And all that contrived just to add a little bit to residential demand. And what we're seeing now is, I think, the lagged impact on prices, price inflation starting to increase slightly. But I think it's going to be short-lived. Already, I think we're seeing signs that demand may be flagging. It is the winter months. There is a seasonal factor. But I think it's more than that. I think there's a lack of stimulus and QE2 is wearing thin. Yeah. So we've got a way to go. The household sector remains highly indebted and there are a few issues to work through over the next few years.
Of course, you're looking at QE2 specifically, and that winds up at the end of June. And it's certainly not the only factor that's keeping global economic recovery shaky at this stage of the game. How are you reading that global economic scenario?
Well, it's always funny. These days they don't talk about growth upticks and slowdowns. They talk about recoveries and slowing recoveries. The terminology's changed somewhat. But I think we're in for a period. If you look at the G7 leading indicators, the US and our own leading indicator, the growth rates are starting to point downwards. We're looking at economic slowdown. And I think that's realistic to expect given where oil prices are at the moment and their probably negative impact on the big fuel guzzling economy, which is the US. Those oil prices are too high. They can also add to inflation, and there are concerns obviously of rising interest rates. Rising interest rates would almost definitely have some negative impact on our economy here. So it all looks as though we're heading for economic growth slowdown at least. It is the residential property market is about the economy. It is about disposable income growth, which would slow with a slowing economic growth rate. And so, yes, unfortunately, I think that was a little bit of a summer bump and that we're in for slowing demand in residential property and slowing price growth again.
So how does this translate then into the kind of activity we're seeing in the market specifically? And let's look for one at the kind of supply-demand dynamic that's out there.
Well, at the moment, we had a big building boom a few years ago, and it created something of an oversupplied market. So if we look at our FNB valuers, what they have to say on the matter, they rate demand and they rate supply every time they value a house for us. It's a very subjective rating, I guess, but they generally know their markets. And they are, as a group, still estimating demand as very weak relative to supply, and they've been rating supply as improving over the summer months. I think what happens is, we tend to focus on demand and what happens in demand, but price growth is an interaction between demand and supply. And over the summer months, I think some sellers got a bit more confident, and we've seen improved supply in the market as well. And that also exacerbates the situation, keeps the market relatively oversupplied, and keeps this price growth relatively stagnant.